All right, everybody, welcome to Coffee for Closers. This week is all about life insurance, or this episode is all about life insurance and kind of the overview of life insurance in general. What do we use from temporary insurance and the permanent form of life insurance, and where those different forms seem to fit best based on ages of folks and their plans for their assets and family long term. So we're unpacking all that here today. Hope you guys enjoy. And if you like what you're seeing, don't forget to subscribe, comment, leave us a like even on the vote or on the videos. Those all help. And we appreciate you all viewing. Hope you enjoy. The Foo Fighters.
Foo Fighters.
Foo Fighters. All right, everybody. Welcome to Coffee for Closers. Alex Wellings here. Rick Kallmeyer. Talking about life insurance. We thought it'd be good for us to kind of set the stage for a lot of the folks that watch the show that are in the life insurance world or getting into life insurance, or maybe, you know, what happens a lot of folks have a next of kin, like a son, daughter coming into the business. They want to get them up and going. They're going to teach them into life insurance. This is a good episode for them to watch. We're going to run through, we'll do like a 5-part series, something like that. But this is an overview of the different types of life insurance out there and the options for folks to watch, okay?
Yep.
Or for folks to potentially purchase, I mean. And what makes sense for who? Why do we position one versus another? And I'm sure there'll be some maybe content on some of the options, right?
Yep.
Like some people would say might disagree with some of our opinions on some of it, but that is the nature of the show, right?
Would love to hear it.
So let's start from the beginning. Life insurance in general, supposed to be there for protecting somebody from dying too young, not enough assets, provide for a loved one, a spouse, something like that, from a loss of income, right? They lose that income. Here's a life insurance, gets paid a tax-free death benefit. That's the general purpose. Yep. And so you start by having all of these products basically geared around that thought, but then you get into the world of like some of the permanent life insurance forms we'll talk about where folks started to use these in different ways, right? And so basically you have two pots of life insurance of the life insurance world. There might be more, but general pots as far as what we're concerned with. The permanent forms of life insurance. And then the term.
Temporary.
Temporary forms of life insurance. So let's start with the temporary, the easy stuff. This is what pretty much everybody's employer offers, or somebody would generally start off selling, or like your term life insurance policies. These are anywhere, I don't know, what's the shortest term policy out there? 5-year term?
Probably 5-year. Yeah, I mean, that's not written much, but it'd be like covering.
Well, they got an annual renewable term. I know that much.
Yeah.
Prices just go up each year.
Yeah, that's true. So I guess, 1 year would be if you got like an annual renewable term. I don't know how much that's still like really active on things. I haven't run a lot of like annual renewable term, but I do know it is a policy. So sure. 1 year. Your general stuff's like 10, 15, 20, 30-year kind of term policies, right? Yeah. Again, I guess like an annual renewable term would be maybe for somebody that was like an employee of a large company, right? And then, you're a CEO or something like that, very important to the company, and they want to cover you while you're working, and it's like, hey, we'll just renew this every year that we keep the guy on staff. But yeah, I think term insurance is your core, like you said, the core focus of what life insurance was supposed to be built around concept, right? You have debts, you have people you care about, you want to find something to substitute for you if you were to pass away before those things were taken care of or passed on. And I think just like any other space, companies have gotten more competitive with each other to try to compete and try to get a better leg up. And that's obviously helped the client out more than the company, I would say, because we have substantially different products than we did, 30 years ago, or substantially different solutions to those life insurance needs. So term can be built in really, I guess, the more common forms now of your standard term policy, which is we'll cover you for X amount of time for X amount of coverage, death benefit, right? Your other big, I guess, term policy would be your decreasing style of term, right? Your mortgage protection insurance, as some call it, right? So you start out with a, let's say, $500,000 death benefit, and every year or every 5 years, depending on the policy,
death benefit goes down.
It goes down a little bit lower. Premiums go down. And both definitely have their place, right? If you're a 40-year-old person, you're probably going to be working for the next 20, maybe a 20 to 25-year term policy will cover the mortgage, cover the cars, cover the wife, cover the kids, put them through college, those kind of things. Decreasing term is generally more for like an expense, strictly for the mortgage.
Something amortized, or
So, hey,
something,
look,
something that's going to fall in cost.
Eventually come down off cost, right? So it's like, hey, look, I have enough assets to cover my wife, cover my kids, get them through college, get them through the marriages, whatever it may be. The only thing is, like, I just bought this big new house, right? So how am I going to cover that? Because that's an additional thing, right?
Start getting all the letters in the mail. You close on your house.
Yep.
All the mortgage protection people come out of nowhere.
Yeah,
you know?
out of the woodworks.
Yeah.
So I mean, that's your core, I guess, kind of two tenets, and those are great standalone policies themselves, as well as, like we'll discuss, those can be tacked on to other styles of life insurance too, and those can come real in handy.
It might be my favorite style of life insurance, to be honest. It's cheap, it's affordable, incredibly affordable. The companies out there, you know, some of them will offer living benefits now, which is incredible.
Yeah, that's awesome that they've started to add that onto like a term policy to say.
Yeah, it was never possible. And then convertible natures on top of that. But the thing is like, okay, it's perfect for the style of planning that we a lot of times approach here. Is like, okay, the life insurance need is there because the assets aren't there to take care of a loved one. Let's get ourselves into something like a 30-year term. We then put ourselves in a place where, the premium is a little higher, of course, depending on when you bought this.
Yep.
And then from there, after 30 years of saving, we're going to have projected about this kind of a balance over here in this pot of money that will then be executed for some sort of distribution strategy that will, also play as a death benefit for a loved one if something were to happen where, like a second or a third, a secondary or tertiary distribution option, but primary role of death benefit for a loved one. So if you make it to that 30 or third decade of retirement, then you start to draw on this asset at that point, obviously. But it's also there for a good little nest egg for a loved one to cover burial and mortgage and, other daily life expenses and anything else that might happen, right? And so those types of strategies we plan a lot for here. And the term fits very well into that because it is cost effective and it's not going to be this thing. But then you go out with these permanent forms of life insurance. So why don't we talk about that? Let's talk about maybe the most basic form of permanent whole life. So whole life policies are going to be much more guaranteed in nature, right?
Yep.
They much less flexible.
Yep. 100%.
So you sign up for this, it's going to happen, right? It's going to follow through.
Yep.
Largely have dividend payments.
It's a big bonus on them. I mean, you have your major insurance companies this world, whatever, Northwestern Mutual Omaha, that's the whole thing to it is, hey, we have this whole life policy, guaranteed insurance as well as a guaranteed payment. Which more frequently than not are probably the more expensive policies. But again, you're
probably the most expensive form of life insurance whole life.
You're trading a guaranteed death benefit with a guaranteed rate of increase, right? Guaranteed growth rate. Usually they'll stick you at a fixed rate for the life of the policy. And then again, you do have the dividends that can help pay for some of the premium. So it's a very fixed chassis, and for that guaranteed and fixed predictability, you got to pay for it.
And so a lot of advisors will take, instead of starting this other pot of money over here later on in retirement, stuffing it into some tax deferred vehicle or something like that, or tax, like a Roth of some sort, right? We'll tuck it into the life insurance policy. And this is true for ULs and IULs, but we'll talk about that as well. Pretty much any form of life insurance, we'll overfund it and we'll allow dividends, of course, to help take care of premium payments, but also the cash value to take care of premium payments, overfund it to the degree where we have this savings account that we can take loans against tax-free in retirement. So it's like, well, which do I want to use? The cash-free or the cash value savings account built into this life insurance policy and have a little bit more expensive premiums, but also not have to deal with the liquidity issues of a Roth, right?
Yep.
So I have full access to this anytime I want it. So if I'm a young person and I know I want this life insurance to give me that guaranteed death benefit, so pennies I put into this are going to pay out one day when I pass to a loved one of some sort, plus be able to build some cash value there, plus dividends. And it's all pretty much guaranteed other than obviously the cash value accumulation, of course. And, and some other stuff. I've got myself the ability, if I'm young enough, to maybe pay for a house out of this money or to take a distribution on this Whereas with a Roth, I'd have much less flexibility there.
Yep, absolutely. And again, so 100% will, on that Roth side of things, right, your IRAs you can't loan against. You can't offer up as a loan or I guess collateral for a loan.
Yep.
So having that bucket of money to loan against is fantastic. And really the downside is that just when you pass away, that money will be less of what you're giving to the person, right?
Right.
You know, even whereas like a 401k, typically you're supposed to pay that 401k back eventually, right? They'd like you to.
If you loan from the 401k,
yeah, they generally, you know, would
well,
like you to pay
if you're
it back.
allowed to loan from the 401k.
Yep.
How many allow you to do that?
Not many.
What about an IRA? Like that's essentially what we're talking about is like
IRA,
stuffing money into an IRA.
IRA you can't. So like an IRA, regular IRA, Roth IRA, you can't offer as like consignment or collateral for a loan. They'll make you like force the policy out.
Yeah, there's nothing to do, right?
Yep.
Like, so I'm saying is like, it really is like, this is the death benefit that picks up at the end of life. Well, with a whole life, I've got the death benefit already there, right?
Two birds, one
stone. It's
stone.
gonna happen. Plus I've got the cash value sitting here that I can use as a distribution option, because that was what I was saying before. It's a tertiary distribution option for if you make it to the third leg of retirement, right? Well, here it is right here, but I also have some flexibility with this to use it for a house payment, a major medical procedure, something like that that might come up sooner than 59 and a half or something.
And not have to draw your assets down, just draw your death benefit down, right?
Right.
Yeah. Yeah. It's good policy.
Or just your cash value down, right?
Which would eventually be your death benefit when you're passing, right?
Sure. Right. Good point. Yep. Now, on the other side of it are your ULs and IULs, which are essentially cheaper versions of whole life, right? They found ways to take some of the guarantees away from the growth options on these products to pay down some of the premiums, right? Or take some of the growth potential out of it and plug it into paying premiums down, as long as the growth actually happens, right? So if the growth doesn't happen as premiums start to get bigger, then it's not really going to pay down the cost of insurance enough to have warranted not going for the whole life policy in the UL situation.
Well, that's the theoretical process, right? It's like, hey, if we can pay enough into this thing for 10 years, there'll be enough cash value into the policy that its own growth will help pay for the premiums of the policy.
Exactly.
Whereas a whole life policy, you're stuck on that payment chassis for your entire life or until it endows, right? Whereas a universal life, you have a little bit more of the flexibility with those premiums saying, hey, look, if we can pay more now, we won't have to pay as much, or we won't have to pay anything later on. Right. Same with the index concept. Is it just hopefully now we've got an index in there that if the market treats us well, it'll be even quicker. Right?
Yeah. And then the index option is just the same as the UL, but more tied to market performance.
Meaning more possibility for growth, more possibility for returns,
but also more potential for not covering the cost of insurance like it needs to, right? Because it's not allocating dollars early enough to paying premiums. Like they haven't figured it out to the T and made these guarantees and charged you earlier the cost. They're bringing the cost down, assuming market performance is going to take control of a lot of this stuff, and it's not necessarily always the case. And so what did we see with IULs? And we'll do more deep dive onto IULs. IULs, a lot of times when it first came out, it was the Wild West. And I think IULs get a bad rap because of the illustration capabilities back then were unregulated to some degree.
Yeah, to most degree.
To most degree. I think I saw things like caps at like 17%, and you could run the illustration all the way up to that. And
17% return every year.
And you're like, oh my gosh, like this is ridiculous. Then people sold it on that, said, hey, we could max fund this thing we'll do like 10 pays into the policy, and it's going to take care of everything, and this is what the cash value will look like.
We don't even need to do a 10 pay. We can do a 5 pay. You're going to get a 17% return. We'll pay it for 5 years.
Bingo, bango.
Never have to touch it, right? I think this is the problem where IULs get kind of a bad rap too. It's as an advisor that has, a couple hundred clients, right? You can do annual reviews and it's important to pay attention to stuff, but it can be difficult to break that policy open well enough to see how the funding is being processed and see how healthy it is, right? So very quickly it can get away from a client, right? Or we have a couple bad years in return, or the premiums have to be increased because of XYZ reason, right? And that policy starts becoming underfunded, right?
Yeah, definitely.
And you typically don't get a warning that there's not enough money in here until it's too late.
Well, yeah, because the end it is like, oh, you just got your interest credited at the end of this year. It's an annual point to point, let's say. Okay, great. But then cost of insurance increased, and you're almost wanting to be like, oh, okay, well, the cost of insurance increased, so I need to get more performance out of this. But then they're finding out, oh, wait, market was down. It's not like, oh, market was stable, and now they're increasing, and so now I make an adjustment to the account to account for that, and, that's how we're going to stick to the plan or whatever. But no, you find out that you're down and they increased costs, and now you're like, it's even more down. It's like a fee. The fee is the cost of insurance. And then so if the fees are almost variable in an IUL based on their needs to increase the costs of insurance or something, and those are gobbling away, especially if the market performance doesn't do well. And so if you're basing things on like 17%, well, first off, the insurance company is just going to adjust those par rates, those cap rates, those spreads, because they're aiming for something more particular. And so it was just this wild west of non-regulation. It's like, this is where regulation does come in to some degree and help folks, because the regulation there was, the lack of regulation was just making it to where IUL's a seemingly decent product for some folks, sold in the right way. Somebody in their late 30s to high mid 50s almost. Like that's an ideal prospect for an IUL. Why? Because they're kind of at the higher age, so where their term policy premiums are going to get up there. Their whole life premiums would be really high. Their UL policy premiums would be very high. And so an IUL offers them a way to kind of bring down the costs to what it would have been maybe a decade earlier, right? And so that's what it really needed to be sold as. It didn't need to be sold as, oh, it's going to be this tax-free distribution strategy, and we're going to be able to quadruple our money in 5 years, or whatever it was,
and then withdraw the same, ridiculous amount every year out of it.
But again, it's like, so then more conservative illustration options came out, and you start to see some of these policies more recently getting a better wrap. Like you can see planners putting together better proposals for their clients that are staying in force. It's not to say that every early IUL sold is blown up at this point. It certainly isn't the case. But a lot of them did. Because folks didn't really understand how to sell
premium in it to keep it in force.
Oh man, what a painful conversation that is. Like, oh, the plan went awry, and now we really got to dump it in because we committed so hardcore to this for tax-free strategy or whatever. And so anyway, the IUL has put this plan. So it's really a spectrum of permanent insurance, right? Where it's like you've got your most expensive with the most guarantees. You've got the IULs with the least guaranteed and the least amount of premium in the permanent world. And then you've got things from simplified issue and guaranteed issue to fully underwritten, and that'll also kind of play with that spectrum. And so it becomes this whole journey of like, how young are you?
How healthy are you?
Right? If you're a young, healthy person, I generally look to a whole life policy, right? Get it permanent, put yourself on a plan, have a foundation. You could even add some term on top of that. And then you've got an ability to really bob and weave. If you get into your 30s, I'm going to start looking at potentially term policies, or I'm going to start looking at
maybe
a UL or even an IUL. And then when I see people get into their 40s, it's like lower band terms and looking at like IULs. And then
or
in
how
their
much
50s,
money do you have to spend? It's like, you really want to spend some money, we can do it, but
sure, of course,
this could be a lot better.
But then in the 50s, lower band terms, IULs, and then in the 60s, we start questioning, like, if you still need life insurance, what is the game plan to not need life insurance forever? Because you really can't put a plan together of like, we're just going to buy a permanent life insurance policy because we're never actually going to stuff money away. You know what I mean?
Yeah, at that point at like 60, 70, right, you have to really start considering, hey, this vehicle is truly going to be a death benefit vehicle. I'm not going to have any other purpose for this money. Like, I'm strictly going to leave this to my heirs.
And how much money do you actually need to leave to an heir? Like, you've almost given up on that opportunity now.
Unless you have a good income, a lot of maybe retirement money's coming in.
But again, too, it's like you'd almost be better off looking at like annuity options with doublers for death benefits and stuff like that. Better
would be much easier.
Yeah, for death benefit options rather than going through life insurance, because you go through that life insurance portal, you're gonna have to go full underwritten in order to get a decent policy, you know, and shorter
and if you're
bands.
healthy, right? So there's a benefit, right? If you're like a true higher income earner, like doing well, there is somewhat of a benefit to doing a IUL if you're really trying to leave some serious money to the kids. Like if you're trying to do some generation stuff, being a little bit older increases your premiums, right? Which means you can dump more money into the policy without making the policy out, right? So there is some advantage if you're really like, if you're a high net worth income earner, you know, you could, you know, and still, you know, whatever we'll call it, 60, 62, something like that. You're expecting to live a long time. You've got longevity in your family, right? You can really front load a policy, really dump some premiums into it without making it out, without causing a problem, and leave a pretty good tax benefit for the kids.
It's true.
When you can't get a term policy because they're looking at saying, hey, look, you know, we're going to give you a 10-year policy at 60. And you're like, well, look, everyone in my family's made it to 85 plus, so 10-year term is going to be useless for me. That could be a way to do it. But again, you got to have some money to be, you know.
Then you've got the whole world of premium finance, and you get the whole world of like key employee, like you were saying before we came on. Those are totally different bag of wax. We could do an episode about that, depending on you know how much time folks want to invest in hearing
how
that.
Much you want to hear it. It's a very specific niche market.
But there you go. You've got kind of the spectrum. So if you're new to the life insurance world, this is kind of a good rule of thumb, the basics, and I'd love to hear people's comments on it. But that's basically how we see the life insurance world. And you know, if there's somebody out there that has a ton of experience in life insurance, one, I'd love to hear your thoughts. But two, I'd love to hear, you know, if those folks want to come and share their wisdoms a little bit more on how they position life insurance on the show.
Absolutely. I think there's a lot of very passionate and specific opinions on life insurance. I really enjoy that. You have people that are like, look, I've written whole life for 30 years. This is the 10 reasons why it's better than IUL.
You're missing it, man. Yeah, you're missing
vice
it.
Vice versa. It's like, I would never write whole life insurance. IUL is better. So it's
but it is good to hear those plans, because again, and you know, folks, we're just talking in generalities. You know, in general, this has kind of been the case. But I loved hearing those specific sales processes. You know, so anyway, that's it for today. Coffee for Closers. We're talking more about some of the closing strategies next week, so that'll be fun. But appreciate everybody hanging on. We'll see you right here next time on Coffee for Closers. Take care.